Have you ever thought about how a giant company like Amazon knows the exact cost of the one book they just shipped to you? I mean, they probably bought that same book at 10 different prices over the last year. It's this huge puzzle that businesses have to solve, and today we're going to crack it. So, here's our game plan. We'll kick things off with the big question at the heart of all this. Then, we'll look at the two main ways companies keep track of their stuff. After that, we're diving into the three core methods they use to figure out the cost. We'll run some numbers to see it all in action, and then we'll wrap up by seeing why this one decision can be worth millions. Okay, so let's get right to the heart of the problem. Imagine you own a shop that sells coffee mugs. In January, you buy a batch for $10 each. But in February, your supplier raises prices, and the next batch costs you $12 each. So when you sell one single mug in March, what was its cost? Was it 10 bucks, 12, or maybe somewhere in the middle? Answering this correctly, well, it changes everything.
And that is the million-dollar or, billion-dollar question these methods are built to answer. It's not really about tracking one specific physical mug from the shelf to the customer. It's about applying a consistent accounting rule to figure out the cost. And as you're about to see, the rule a company picks has a massive impact on its bottom line.
But hey, before you can figure out the cost of something you sold, you've got to know what you have in the first place, right? This is kind of the first step, the foundation for everything else. And businesses generally do this in one of two ways. First, you've got the Perpetual system. Think of this like a live, real-time dashboard for your inventory. Every single time an item is scanned at the checkout, the system instantly knows one is gone and updates the numbers. Then there's the periodic system. This one's a bit more old school. It's like closing up shop once a month or once a quarter and physically counting every single item on the shelves to figure out what you have left. All right, so we know how companies track their inventory. Now for the main event, the actual rules they use to assign a cost to the items they sell. There are three main ways to do this, and these methods are what finally answer our big question. First up is FIFO. That stands for first in, first out. And the logic here is pretty straightforward, right? It just makes sense, and it matches how most physical products actually move. A grocery store wants to sell the oldest carton of milk first before it goes bad. FIFO just assumes your business's costs work the same way. Next, we have its opposite, LIFO, or last in, first out. Now, this one can feel a little weird at first. It assumes that the newest items you just bought are the very first ones you sell. The analogy of a stack of papers on your desk is perfect here. You don't dig to the bottom, you just grab the one you put on top last. And finally, we have the great equalizer, the weighted average method. This one just smooths everything out. It says, let's not worry about what came first or last. It just calculates one single average cost for all the identical items you have in stock, and then applies that same average cost to every single thing you sell. It's the middle-of-the-road approach. Okay, theory is great, but let's actually get our hands dirty and see how this plays out in the real world. We're going to take one simple set of transactions and run it through each method to see just how different the results can be. So here's the setup. We start the month with 100 units that cost us $10 each. Then, as the month goes on, we buy more. But you'll notice the prices are rising to $12 and then to $14. Our job is to figure out the cost for those two sales, the ones with the question marks. Okay, let's start with FIFO. We sold 80 units on January 10th. Now, what's the rule? First in, first out. That means we have to use our oldest inventory first. So we look at that initial batch of 100 units that cost us $10. All 80 units sold come directly from there. The math is super easy. 80 times $10 gives us a cost of $800. Now let's run the exact same sale, but this time using LIFO. The rule is last in, first out. So we have to start with our most recent purchase. That would be the 50 units we bought on January 5th for $12 each. We use all 50 of those, but we still need 30 more to complete the sale. So now we have to dip into the next newest batch, which is our original inventory at $10. You do the math and the total cost comes out to $900. Okay, let's just pause right there for a second. This is the whole point. We sold the exact same 80 items. Nothing physically changed. But just by picking a different accounting rule, our cost of that sale is either $800 or $900. That $100 gap from just one transaction is where the stuff gets really, really important. So we went ahead and did the exact same exercise for that second sale on January 25th, and we also ran all the numbers for the weighted average method. And after crunching everything for the entire month, we can finally pull back and see the full picture of just how big of an impact these choices really make. And that brings us to the final tally.
Let's lay out the end-of-month results for all three methods, side by side, and talk about what this actually means for a company's financial health.
Just look at these final numbers. The cost of goods sold, which is just the total cost of all the stuff we sold during the month, is highest under LIFO at $1,660, and it's lowest under FIFO. But then, look at the other side of the coin. The value of the inventory we still have left on the shelf is highest with FIFO. See that? It's a perfect inverse relationship.
This chart just makes the difference so clear. You can really see that gap. LIFO created the highest cost of goods sold, and that's because it used the newest, most expensive inventory first. Remember, prices were rising in our example, and that's what makes this difference so dramatic.
So who cares? Why does any of this actually matter? Well, that cost of goods sold number is one of the biggest expenses a company has. So a higher cost, like the one we got with LIFO, directly leads to a lower reported profit. Now, lower profit might sound like a bad thing, but think about it. A lower reported profit can also mean a lower tax bill. This one accounting choice directly impacts how profitable a company appears to investors and how much cash it actually pays to the government.
And all of this leaves us with one last really fascinating question to think about. Which method actually tells the truest story? Is it FIFO, which neatly matches the way goods physically move? Or is it LIFO, which does a better job of matching your most recent costs against your current sales? You know, there's no single right answer, and it's a debate that lives at the very heart of how we measure business performance.